Thank you for joining us. I welcome my esteemed speakers and audience to the 5th Proshare Tier 1 Banks Report virtual discourse, looking at the theme from capital adequacy to business resilience, assessing the outcomes of the banking recapitalization. Before we proceed, permit me to set out a few housekeeping rules to guide the webinar. For all technical issues, kindly use the chat forum and direct them to the host. All attendees' microphones are muted to prevent interference. You can submit questions via the Q&A icon. Decorum standards within our governance ethos are in place and will be activated even as we encourage everyone to express themselves. Finally, do note that this webinar is being recorded and live streamed on the WebTV YouTube page and our social media platforms. As a measure of the citizens' pulse, we will be conducting polls intermittently. Nigerian banks have completed a major capital raising cycle and the result is evident. Today's task is to assess the quality, deployment, and outcomes of that capital, together with the implications to the recent rerating of banking equities for investors, bank boards, regulators, and the wider economy. With over 4.65 trillion raised and 33 banks cleared, the post-recapitalization phase will be defined by capital quality, effective deployment, resilient earnings, disciplined risk management, and productive economic activity. I would now like to invite the chairman of Proshare, Mr. Lufemi Aweyemi, MNI, for his opening remarks. I yield the floor to you, sir.
Thank you, and good morning, distinguished panelists, colleagues, investors, market operators, and members of the banking community, and guests joining us today. On behalf of Proshare, I welcome you to this virtual discourse on the 5th edition of the Tier 1 Banks Report titled Nigerian Banks Post-Recapitalisation, the class of 2026. The Nigerian banking industry completed its largest modern recapitalization with 3 banks raising 4.65 trillion. However, institutional strength will ultimately depend on capital quality, effective deployment, resilient earnings, disciplined risk management, and support for productive economic activity. The recent rerating of banking equities since that report was published has strengthened market confidence and may provide banks with an additional window to raise capital. It also places greater responsibility on boards and management teams to ensure that market valuations are supported by asset quality, credible disclosure, sustainable profitability, and risk-adjusted shareholder returns. Today's session brings together perspectives from investment management, capital markets, banking operations, and independent research. We expect contributions to help investors and decision makers distinguish balance sheet size from institutional, nominal returns from real performance, and capital adequacy from capital effectiveness. On this note, I personally thank Mr. Johnson Chuku, Dr. Ayodeji Ebo, Mrs. Bumiola Dosu, CFA, and Mr. Teslim Shitabe for accepting to lead this engagement. I also look forward to Otto Abbas's moderation of the panel exchange and thank everyone joining us across the market. Our purpose at Proshare remains to provide data and evidence-backed analysis that explains what developments mean, while we enable stakeholders to form informed perspectives and take appropriate action. I welcome you once again and wish us a productive discourse. Thank you, and over to you, Otto Abbas.
Thank you very much, Chairman. Very insightful remarks on this very interesting webinar we're looking forward to. And like Riley said, it's going to be a very interesting conversation. So I'd now like to invite our participants for our first poll for the webinar. Thank you very much for participating in our first poll for the webinar. I would now like to move to a brief presentation on the 5th Proshare Tier 1 Banks report by Mr. Teslim Shitabe, Director of Research, Proshare.
Thank you. Thank you very much, Mr. An insight into the Proshare Tier 1 Bank report for 2026. I'd like to address 5 things in this brief presentation. The first thing I want to address is, why does Proshare do reports in the first place? After that, I would like to talk about the methodology and the methodology shift. Now, after that, we'll look at the current ranking. Since and of that report, which we can all have a conversation around. Now, let me start off with the reason why we do the report. I'm very delighted to have Dr. Ayodeji Ebo here today, because himself and his team were the pioneers of the report in assessing Tier 1 banks in Nigeria. What Proshare did, therefore, was to say that we noticed that there was a kind of static structure to that report, and we needed to add a few more variables to be able to test the credibility of the report. And that's what we did in 2021. Has gone under 5 different iterations. We've gone through different approaches to understand whether a bank Tier 1, 2, or perhaps introduced later on Tier 3. It's important for us to understand that this is not a league kind of arrangement. It is not designed to rank banks according to a particular league, but it does understand the strength, the underlying strength of a variety of banks that we have termed Tier 1 banks. Now, Tier 1 banks, one of the major things I would like to say is that
Teslim, I can't hear you. Can you hear me? All right, well, we'll try to get Mr. Teslim. Of course, the presentation of the 5th Tier 1 Banks report comes at a critical time as we evolve in the phase. So, Mr. Shitabe, you can continue.
Also, can you hear me now?
I can hear you, yes.
Okay, thank you very much. So it's a slight glitch there. Now, when we started the Tier 1 Bank report in 2021, we had 5 variables. So these 5 variables we felt would be adequate to determine the strength of a bank. However, as the economy grew and as certain fiscal and monetary policies took place, we realized that we needed to go beyond those 5 variables, and we stretched the variables to 13 variables using a multiple regression analysis. By 2025, which this report actually reflects, it reflects the reports produced in 2025 as of December 31st. Now, in 2025, we realized that, look, we need to improve upon the methodology. The methodology in 2025 was a panel analysis. It wasn't the previous multiple regression analysis, it was a panel analysis where we took 25 variables across 10 categories of classifications. This was a massive amount of work that needed to be done. But we took up the challenge and decided that what is worth doing well. So we decided that 25 variables along 10 different classifications would provide us with greater insight. Another key issue in this report in terms of methodology is that we decided to integrate considerations by regulatory authorities. The CBN's consideration for the classification of banks, as well as the Securities and Exchange Commission and the Nigerian Exchange Limited. We decided to take on board their own analysis of classification of different institutions listed on the exchange. Now, this classification were taken in, but were expanded. And therefore, we decided that, look, we think that there should be some metrics for markets. How do these banks rate in the marketplace? So here we have an analysis of the price to book value of the various banks. And we decided to take 45 banks across Africa, the top banks across Africa, and measure the Nigerian banks against these banks in terms of their price to book value. And we came out with some very interesting outcomes here. One I'll quickly say here is that we found out that the median price to book value of banks across Africa was 0.99 times. Now, in Nigeria, none of the banks, as of December 31st, 2025, got to beyond 0.7 times. That was for us a major indicator of the need for the recapitalization itself. It was evident that the market was not pricing in the underlying true values of the Nigerian banks. And as you see on the screen here, you can see the PPSI composite scores for 2025 and the relative rankings. At the top, we had GTCO. It was followed by Access Bank, followed by Zenith, and the surprise of this particular report, the introduction of Wema Bank. Then we had EcoBank. And at the bottom of this ranking, we had Sterling Bank. What is important here is not so much where the banks ranked, it was the fact that at a continental level, these banks were relatively underpriced compared to their African peers. And for us, that became a major issue of conversation. However, I must say here quickly that since then, the price to book value of Nigerian banks, for many of them that have released their half-year 2026 report, many of them seen values of about 1.2 to 1.56. So we've seen a massive improvement in the price to book value. The market seems to have caught on and started adjusting prices to reflect the underlying book value of Nigerian banks. As we can see here also, one of the things that we talked about, which is the second point I want to make, is that capital size is different from capital effectiveness. In the past reports, your size actually determined or reflected how effective you were as a bank. In the new report, maybe because of the expanded methodology, we found out that capital size is good, but capital size is not definitive. And that's why you see GTCO suddenly rise to the top. And then we saw a bank like Wema Bank come in at 4th position in this particular report. So obviously, Wema Bank doesn't have the total capital size of a GTCO, a Zenith, or an Access Bank. But in terms of effectiveness and efficiency of capital deployment, it is ranking with some of the top players in the banking industry. And maybe I should also point out that there was a very good outcome when it comes to capital adequacy. We have seen most Nigerian banks meet the capital adequacy condition of 15%. Most of them are way above. We have banks that are 25, 28, 35% capital adequacy. Now, what the rankings therefore portray is that Nigerian banks are definitely becoming stronger. But are they becoming more effective in capital deployment? Those are issues that we will expect to see as we get the outcomes of the results for 2026, especially half-year review and the final year outcomes. We'll see, we believe that there will be a massive improvement in some of the key ratios of the banks. Now, so I think I should go to the third item I wanted to discuss, and that's developments since the report. I had alluded to it a bit earlier. Since the report, several banks have done a lot better in terms of their price to book value. Price to book value of several banks, as you can see here, have crossed the 0.99 median price to book value for African banks as of December 31st, 2025. Yes, there are still banks that are lower than the 0.99 times value, but we've seen several banks do a lot better than that. And here on the screen, you can see the performance of the respective banks that were within our ranking range as of 2025. I must say that there are 3 other banks that were considered. However, because the results were and reports for the financial year 2025 were not available as of the time of putting the report together, we were not able to capture them in the report. I also want to say that the report was released, it was completed in June 2026, but we decided to release it in July 2025. Now, this is where I think we have the key issues that need to be discussed. And I'm hoping that the panelists today will do justice to some of these issues. Now that banks have more capital in their kitty, are we expecting non-performing loans, for instance, to rise or fall? The logic would basically be because you have more loans, you are granting more loans, the possibility is very evident that you're likely to experience non-performing loans increase sizably. But then again, from what we're seeing half year, that isn't the case. Even though banks have recapitalized, have had more money available to them, the non-performing loan ratios have been very decent. We've seen non-performing loan ratios of about 3.85%, 4.49%. These non-performing loan ratios are below the statutory maximum of 5%. So despite the fact that we've seen more capital in the system, we're seeing also that non-performing loans have been moderated. Another thing that I think we will have to discuss is that we have 5 banks which were barred from paying dividends in this during this exercise. And shareholders were not happy about it, but definitely it was consistent with the regulatory architecture of the Central Bank of Nigeria. But we have sovereignty over what are those conditions that bar a bank from actually not paying dividends, because these have market implications. And like I said earlier, we have a situation where we decided to make this report sensitive to the market. Then we saw that the banking index has climbed 22.1% in a single month. And that creates some evidentiary a categorization of banks, that the burden on boards is becoming increasingly more aggressive. Boards are going to have to demonstrate that the rise in capitalization also provides value for investors. We can ask ourselves, why is the conversation needed now? Well, one of the reasons is that the market is pricing an outcome that the financial year 2026 results have not yet demonstrated. And I think in the course of conversations today, we're going to have detailed discussions about aligning capitalization, pricing, and investor outcomes. Points the report covers. I would hope that Dr. Ayodeji Ebo, Mrs. Bumi Oladosu, and my brother, the chairman of chairman, Johnson Chukwu, puts in their thoughts to give us a detailed insight into what the implications are for the banking sector post-recapitalization. Thank you very much, Otto.
Thank you very much, Mr. Testim Shitabe, Director of Research, Proshare, for that robust and enlightening presentation on the 5th Proshare Tier 1 Banks report. One thing that resonates is that beyond capital size, capital effectiveness is critical for the banking industry post-recapitalization. As we anticipate our panel session, I would like to invite our participants to the second poll of the webinar. Thank you. Thank you once again to all our participants for being involved in these poll sessions. Thank you once again. I would now like to welcome our speakers for the virtual discourse on the 5th Proshare Tier 1 Banks report. First is Mr. Johnson Chukwu, is the Group Managing Director of Cowry Asset Management Limited. Mr. Chukwu is the founder of Cowry Asset Management and has extensive experience across banking, investment, management, treasury, risk operations, and capital markets. Next that we have for this conversation is Dr. Ayodeji Ebo. Dr. Ayodeji Ebo brings experience in economic and investment research, securities dealing, investment strategy, and capital market development. He is the MDC of MDU Capital. The third panelist for this conversation is Mrs. Bumi Oladosu, CFA, Chief Financial Officer, Wema Bank PLC. She's a finance professional with more than 20 years experience across financial control, taxation, cost management, performance reporting, audit, and corporate finance. And lastly, in our conversation, but very critical to the conversation, is Mr. Teslim Shitabe, Director of Research Proshare. He's an experienced investment banker, financial modeler, market analyst, and financial journalist. Thank you all for being part of this conversation. I'd now like to begin the session with you, Mr. Johnson Chukwu, for the first round of questions. And to our panel of discussants, the first round of conversations will be 2 minutes response each so that we can really have a robust conversation. So to you, Mr. Chukwu, this is the first question for the conversation. From a capital market perspective, as a capital market leader, the industry has raised a substantial volume of new capital through the recapitalization exercise. What has driven the re-ratings of banking equities, and which drivers appear durable at this time?
Thank you, Otabasi. Let me start by thanking you as the moderator, thanking Teslim and Femi and all the members of the panel for putting together this session, this discussion session. The factor driving the rating of the bank's equities is going to be the quality of their earnings. And when I talk of quality of earnings, I'm talking of current earnings as well as the impact, the cost of credit, the cost of earning those current earnings. Because in the past, if you cast your mind back to the capitalization that took place in 2006 to 2008, the Nigerian capitalization of the Nigerian banking industry, what happened was we had a win-win of improvement in earnings as a result of lending that were high risk. A lot of massive lending went into the stock margin market, into the oil and gas sector, and those things came full cycle. So as we speak today, the banks have raised substantial amounts of capital, and so the question becomes, how are they deploying the capital? Good a thing for them, contrary to what we had in 2006, 2007. 2006, 2007, as a result of the global economic crisis, yield on fixed income instruments collapsed. I remember yield was in the region of 10%, less than treasury bills came below, became single digit. And the banks were looking for where opportunities were, which was why lending to the oil and gas sector and lending to the capital market became very attractive. So when the market collapsed, oil and gas sector went down and the capital market went down. The banks were already carrying a huge percentage of their loans in very weak assets. I do not think that will repeat today. And what is happening today is that the banks are leveraging on the benefit of investing in federal government debt instruments. If you look at OMO instruments, yield on OMO instruments are above 20%, or in the region of 20%. And the banks, what they're doing is basically mobilize deposits at lower double digits and buy treasury bills. Because if you look at buy OMO and treasury bills, Because if you look at the growth in terms of their lending to the real sector of the economy, it still remains very weak. We've not seen a material improvement in lending commensurate with the increase in the capitalization of the banks. So the banks are playing safe. So what will matter, what we count most, is ability to earn sustainable quality earnings, ability of a bank to maintain sustainable quality earnings, so that short-term profit does not jeopardize long-term solvency, as has happened in the past.
Thank you very much, Mr. Johnson Chukwu. Very concise answer to that. So we'll be looking at the sustainability of quality earnings. That's what we'll be looking at as we assess how the banks evolve in this post-recapitalization phase. Thank you very much, Mr. Johnson Chukwu. And of course, you made a comment about banks leveraging the federal government debt instruments. That's a very interesting conversation. Now, to you, Mrs. Oladosu. Ms. Bumi Oladosu, as a CFO of a bank that was captured in the Tier 1 ranked table of the 5th Proshare Tier 1 Banks report, and of course, that evolution is quite remarkable. How does management determine the balance between capital preservation, credit growth, technology investment, and shareholder distributions?
Well, thank you once again for having me here. Like we said, some of our discussion will try to be as neutral as possible, but we will not deny the facts of the matter for the benefit of those that will want to learn from it. Definitely. For Wema Bank, I mean, we've come a long way. And people are asking the same question you are asking this morning. And one of the major things that I'm going to say is that to raise capital is one thing. To have quality capital is another. And when you raise capital, you are just starting. You talk of deployment. After deployment, you talk of monitoring. So, you know, it's a circle. But what normally happens is that everybody jump on the ship and try to rejoice when capital is raised. So for Wema Bank, one of the things that we have done is that we compare sustainable growth against expansion. You may not be able to link us with the big bank with large base, but what we have done over time is to create a niche for ourselves and try to distinguish ourselves in that area. We have raised capital. We don't have issues with that. Now, in terms of development and deployment, there are some things. Look at the kind of risk I want to take. Where are the sectors that will give me value at the lowest risk whatsoever? Then I deployed to that place. Then I now said, okay, while I have deployed as well, there is what we call the monitoring tool for the credit. I must be able to see the warning sign. So immediately I start seeing warning sign. As I try to make provision, at the same time, I step in. It's not about recalling credit. It's about doing all that is required to ensure that the obligors stay afloat. So before I recall credit, I first give the support to my customer. So for Wema Bank, in terms of innovation, in terms of technology, in terms of credit monitoring, and in terms of risk adjustment return, we create a balance. And that's why it looks as if we are small, but at least we're efficient in some areas. I don't think if I've given a good answer so that I don't prolong the discussion. Thank you.
Yes, thank you very much, Mr. Oladosu. A very, very interesting answer. But of course, you've explained the trajectory, how you've evolved, not trading value for size, and of course, comparing sustainable growth with expansion, and of course, looking at your risk, ensuring that they are effectively deployed, given what Mr. Johnson Chukwu said in the past about what happens to banks when they lend to the oil and gas sector and what happened. And of course, investing in technology. Those are very interesting insights that you've raised, and thank you very much. To you, Dr. Ebo, from a fund and portfolio management perspective, which analytical criteria do you consider to be of pivotal importance to bank stability going forward?
So I think the first thing I would like to state is thanks for inviting me to be part of this laudable initiative. And over the years, it's been a privilege to be part of this great initiative. So the first thing as an investor or a portfolio manager is what you look out for is sustainable ROE, return on equity. And you would see very interesting because I began to pick much interest in WEMA, this, which we have seen over the years, even for foreign portfolio investors. There's a strong correlation between your share price or your valuation in terms of price to book value and the ROE. Investors are really very keen. And why did I also add sustainable ROE? Meaning that it is income or profits from recurring revenue, not one-off, not based on FX gains, not which is not recurring, not based on the valuation of your assets. So when we look at banks, if we are sure that you are going to be sustaining that profitability and your ROE is above average, you would see the market will price it in. It's really very important. Yes, currently we have one or two anomalies that's low ROE, high price to book. But we know that market will always win. It would reflect it based on my own experience over the years. So when you look out for that, the return on equity. Secondly, look out for new products. Are they introducing new products that, especially within the retail space? Because one thing about banks that have also sustained their ROE, high ROE, it's also synonymous to low costs of funding. So if they are able to mop up low costs, it means that their funding cost is really low. And as a result, it will improve their net interest margin, or when you say their NIM, when you look at it. So that is also very important. Then we also look out for the cost to income ratio, because that also is also linked to the profitability. So when you see banks that carry very high cost to income ratio, definitely it leaves less for the shareholders. And when we look at return, you can have very huge balance sheets. But at the end of the day, what is the return on asset? What is the return on equity? It's also very important. You look at the likes of GT Bank, we let to cover it over the years, and you would see that they've been consistent. So when you look at Stanbic and GT Bank, now WEMA is also, when you look at classification based on ROE, is also in that league, high ROE, and you would check their price to book value. It's also very high. And because market also look at that. So if banks, if we look at those parameters and we see that there's a bit, or you are able to sustain it beyond the market, as an investor, so we know our market loves dividend. So for companies that pay dividend, yes, also their market sentiment beyond the fundamentals that you look at, it also plays a major role that you play, that they pay dividend, because you also look at the rule for even the pension guys, for them to invest in your stock, you must be able to have paid 3 out of 5 years. So that also has a way that it plays in the market valuation of some of those stocks. So we're always on the lookout for some of those indicators before we throw our money on those banks.
Thank you, Dr. Ebo. Very interesting. Of course, banks leaders and market leaders are hearing this. How sustainable is the return on equity, of course, return on assets, and the new products. What kind of products are on board? So beyond recapitalization, the return on equity, how sustainable is it? Return on assets, new products, and of course, issues around cost-to-income ratio. So it's very, very interesting to continue to track this, and of course, analysts are listening and will get more signaling. Now to you, Mr. Shitobe. You just gave us a brief presentation on the Proshare Tier 1 5th edition bank report. But the proposition in that report shows a shift from capital adequacy to capital effectiveness. Why did the report separate asset size, capitalization, and capital quality?
Well, thank you very much also. I think I stopped from what Johnson Chukwu said earlier when he recounted what happened during the old, or let me say the early recapitalization exercise under the NCBN Governor Chukwuma Soludo, where the aspiration was for us to grow our banks, to make them competitive at a continental level. We achieved that. We did recapitalize from 2 billion naira to 20 billion naira, 10 times the capital in 2000, where there was also a recapitalization exercise that we changed over to universal banking. Now, everybody expected that there was going to be this massive growth in real sector development. There was going to be a massive growth in loans and advances. And as Mr. Chukwu rightly pointed out, yes, there was loans and advances improvement, but the quality of those loans were doubtful. So we saw monies going into large cap activities that really didn't give the returns that the banks required for sustainability. This exercise is different, but it is also a warning. We have done 10 times the previous capitalization. It was 20 billion naira before for the average commercial bank, but it's now 200 billion for national banks, 500 billion for continental, those who are going outside Nigeria and going to do some continental business and intercontinental business. What that means is that we should ask ourselves the question, does size count? That depends on quality of asset creation, quality of the balance sheet. In other words, loans and advances must be of improved quality. So as you grow your books in terms of size, you must also grow them in terms of quality. And I think Mrs. Oladosu also made reference to that in terms of Wema Bank. And it explains why we see Wema Bank in the 4th position in the Tier 1 ranking today. Because as Mr. Dr. Ebo had rightly pointed out, if you look at the risk-adjusted return on equity for Wema Bank, it's just slightly under 30%. Meanwhile, the #1 bank that came in our ranking was below 9%. So even though that bank was #1 because it was bigger in terms of the fact that it had international capital license, even with the national license that Wema Bank has, it still showed underlying superiority. And that's why we decided that, look, you know, we need to separate these concepts. The capitalization issue is a market-related issue because capitalization refers to the number of equities you have in issue multiplied by the market price. So we felt that, look, the fact that you have a high market price and you have a large balance sheet, does it mean that you're effective and efficient in operations? Does it mean that your risk-adjusted return on equity is sustainable and sound? We found out that when you look at the report clearly shows that there are variable nuances in the categorization of banks along those specific lines. When you look at total asset size, when you look at market capitalization, and then you look at risk-adjusted return on the equity, they give different messages. Some banks moved in the right direction of travel. For all those indices, they moved in the right direction. Some banks, they did well in one, perhaps didn't do so well in the other two, or did well in two and didn't do well in one. So for us, those nuances are important and give us deeper insight into how the Nigerian banking industry is evolving as an industry in the country and as a competitive sector on the continent.
Thank you very much, Mr. Shitabe, for the explainer on why the shift and, of course, our emphasis from the 5th Proshare Tier 1 Banks report. And we'll continue to get more insights on this as we continue. And now we're going to our second round of questions. I would like to implore our participants to send in their questions or comments you have. Just send it on the chat box. Would appreciate, and of course, our platforms. Now we'll go to the second round and follow our established sequence. Mr. Chukwu, recapitalization has reshaped the equity market stories of Nigeria's Tier 1 banks. We've seen sizable rights issues, public offers, and new shareholders coming in. I like that last part of new shareholders coming in. So how should investors distinguish market-wide liquidity effects from bank-specific improvement covering the industry?
I think some of the discussion has taken place now so far indicates where the investor should be looking at. When you are talking of bank-specific improvement, when you talk of bank-specific improvement, you're looking at the quality of risk assets. Each bank's performance, long-term performance, will depend on the quality of the risk assets. So you need to look at what is the cost of credit to the bank, how much is the bank providing for non-performing loans, what is the proportion of the bank's total risk asset portfolio that is defective or that is weak. So you look at that, that's a critical factor. You look at any improvement in governance standards, whether there is an improvement in governance standard, because the truth is that with higher capital, each bank should be able to get more quality independent directors, so as to bring some balance in terms of decision making, particularly critical decision making. I think one of the requirements of the central bank is that the credit risk, board credit risk committee should be chaired by the independent director. But it depends on how independent that director is. Three, you have to look at the direction of the bank's investment. I think Bumi has spoken earlier on the fact that technology is an enabler, and also technology is a threat. So the key thing is that you have to look at what's the direction of the bank's long-term investment. Is the bank still building so much of brick and mortar, or is the bank adopting technology as a service delivery channel? And to what extent is this technology competing with the technology available by other fintech operators, because the fintech operators have become major competitors to the banks? Then you look at in terms of deployment, current deployment of the capital that has been mobilized. I said earlier that we've seen a substantial deployment in short-term instruments. And one of the things that I always say the banks should do is that they need to review their risk acceptance criteria and target market. And that will reflect in the quality of risk asset, the type of risk asset that the bank is approving. There's always a tendency that when you have excess liquidity, you loosen your credit standards because you want to optimize the returns that is commensurate with the level of equity you are carrying. Because if you are not able to grow your earnings to at the same minimum, at the same proportion at which your equity has grown, the earnings per share will be diluted, will become weaker, and that would be a negative for you, including the valuation of your stock in the market. So you have to look at what is the bank doing in terms of what sectors is growing, is investing in, because like I said, we have had the experience of concentration of risk assets in few sectors. Today, there are opportunity sectors that banks don't seem to have paid so much attention. If you look at the distribution of the bank's loans, you realize that oil and gas account for the greatest share of the loans, followed by manufacturing, followed by trade. And then the growth sectors of the economy are largely staffed, or the sectors that have strong prospect of growth are largely staffed. The agricultural sector, when I talk agricultural sector, I'm talking of the entire value chain of agricultural sector, including beneficiations, where you have agri-processing businesses that are more durable, more safe, because you have a huge market. So you have to look at which direction the bank is going, making investment, because that's the only way you can measure the long-term sustainability of a bank's profitability. I repeat, the long-term sustainability of a bank's profitability. And that, for me, is how you measure how equity has been deployed or how effective a bank is in deployment of its equity.
Thank you, Mr. Chukwu, for emphasizing the need to understand the trajectory of banks, especially long-term sustainability. And just like Proshare has emphasized in his report, the need to redirect lending and funding to productive sectors of the economy. That will be a game changer if banks beyond recapitalization begin to emphasize on this. And this is critical at this time. Thank you once again for your response, Mr. Chukwu. Now to Mrs. Oladosu. A larger capital base expands lending capacity, gain from what Mr. Chukwu has said, but asset quality and risk management remain critical. For the banking industry, what operating constraints could limit the conversion of new capital into productive lending, productive sectors that galvanize economic activities?
Sorry.
Mr. Oladosu, can you hear me? Yes.
Yes. Can you hear me now?
Yes, I can hear you.
Okay. Bank has raised capital, yes, and we expect lending to flow across all sectors. But there are two facts that we need to take note. One, banks are not government. They have shareholders. And these shareholders are expecting return. The second aspect is that the regulatory body equally has put a limit, a cap on how far banks can go. So if I use myself as an example, I have a limit based on what CBN has put there when it comes to risks that I can grant. So now, what are the things that can hinder me? One, I'll look at my limit. Is it within my limit? Which speaks to my risk appetite. What is the internal capacity that I want and that I can afford? So the second main issue is the bankability of the people. You want me to release credit? I'm just an intermediary. I'm holding forth for some people. So the people that want to take the credit, how suitable are they? How prepared to take the fund? Is the economy supporting the business they are doing? I want to give you a little example. The past government, CBN, decided to help agri. And they said they were releasing money to agri. They were releasing money to health through the banks. But do you realize that bank borne 100% of the risk? So the failure of the agri business that has taken money from the bank rests 100% on the bank. The failure of the health sector that have deployed capital to rests 100% on the bank. So what do you want me to do? So the first thing that will be of constraint to me is that how bankable are these people? How credit worthy? How prepared are they to take the fund and the ability to turn it back? I can monitor after I've provided. Yes, I can guide, but I'm not the ultimate controller of how profitable that business is going to be to make a return to me. So the next thing is that what is the return that is going to come from it? Now, cost of fund. We talked about cost of fund the last time. Is cost of fund cheap? It is not, because cost of fund is a function of the economy itself. As you are sitting down here, you want to give me deposit. You will be telling me rates that I cannot even lend out. So what is the cost? Is cost going to be within the bearable? By the time CBN takes 30% liquidity from me, they expect me to put 45% in CRR, and then the customer expect me to pay interest, and then the balance, I want to give it out as a loan, and I want to return to shareholder. So these are some of the things that we are not considering. So because I want to look at all this, and when the chips are down, the onus is on me, then I'll have to sit down, I have to scrutinize the business very well, and I have to ensure that this customer has the ability to pay back before I release the money. So it's not a function of I have raised capital. It's a function of the deployment to a risk return that is sustainable for me as a bank and that can guarantee return to my shareholders. Another thing is that the operational capacity of the bank. You remember you made mention of 2005, 2006 when bank raised capital. Two things caused the major problem. The operational capacity of the bank moving from 2 billion to 25 billion overnight. Did you give the bank to build the capacity before raising the capital for them? It came so straight. And that was why banks started investing into real estate overnight. You understand? So my operational capacity also, banks need to build up their structure, the culture, the governance, that it will support the capital that have been raised, and then before I can deploy to sector, lending can improve, and then we can all go home and drive. Thank you very much.
Thank you very much, Zolado. So your response really reflects the desires of the industry. While you've clearly said that the banks are not governments, of course, regulation has a role to play, the environment, high interest rates, and the need to really intervene. But you've stated clearly that cost of funds are part of those issues to look at, and risk return, which must be sustainable. And of course, banks have shareholders who are always expecting returns. And a major thing you raised was the bankability of projects or creditworthiness, which is a very interesting chapter now that we're seeing that that's a major issue that the banks are taking seriously to ensure that where they lend is productive and brings returns. Thank you, Mr. Zolado. So this is going to set a very interesting conversation as we go forward. And Dr. Ebo, based on what we've heard, recapitalization is intended to build institutions capable of supporting Nigeria's growth ambitions and, of course, larger economy. And with what Mr. Zolado has said for the banking industry, what are the investor expectations in terms of reported performance in any part of the banking cohort? And you want to make one or two contributions to what she said.
No, I think, firstly, what she had mentioned really, because for her, I think she's even put it in a very light way, because she works in the bank. It's part of what it's reducing even the ability to give credit. We talk about cost of credit really high. When you check the larger banks now, regulatory cost is in billions. AMCON cost, NDIC cost is in billions, because then banks were smaller when it was set as a percentage of total assets. So banks are even trying to be careful to grow their assets so that they don't incur additional cost that goes to the light of AMCON, the light of the regulators. So that cost is significant. So you collect, if I putting it into perspective, you have come to deposit 1 million with me. Based on the guidelines, 45% CRR, you have to keep that. Liquidity ratio, 30%, you have to also keep that. It means that if I've collected deposits at 15%, for instance, and I can only use almost maybe 20–30% of that amount, I will need to triple the rate at which I would give out that particular percentage that is left that I can use for me to be able to first cover the deposit cost before I even cover the regulatory cost. So when we talk about cost of credit, all those costs adds up, which is part of what I feel regulators will also need to look into, even as the banks get bigger. Some of those costs may need to be reviewed downward, because the absolute amount now would be more. And we will need to ask, what are those funds currently being used for? AMCON getting hundreds of billions from banks. It should have been, and the first target was the first 10 years, which has lapsed, and now it's being extended. When will that cost stop? Because definitely it will be passed to the customer. The bank will not absorb some of those costs. So in that light, there's a need to look at the overall cost when we talk about credit. But when we're also now coming to your question from the investor's perspective, so some of the things that we'll be watching out for is to ability to increase, to diversify our business. We know that credit, it's really very key. But like I always say, banks will also begin to carve a niche for themselves. So for a particular sector, because most of those sectors also vary. So you can develop competence that sector becomes your bread and butter. You know how their cash flow works. You understand the risk more and more based on your experience that you've over the years. You cannot play in all the sectors. Yes, we know oil and gas, most of the banks will play, but over time, for them to also be able to begin to channel more resources into some of those sectors, we need to be able to know a bank. And we say Wema is known for the entertainment sector, for instance, because over the years, they have mastered that risk. They try to reduce it, and they will be happy the more they get funds, because they understand that space, to channel more funds into that space rather than across all the sectors. Yeah, so those are some of the things I think some of the investors will be looking out for. Thank you.
Thank you very much, Dr. But one very key thing you've raised there is the need for this regulatory cost to be reviewed for the banks. Of course, it's very important. Some of these costs you've highlighted, and the need to diversify. Banks will diversify business to the areas that they have competence in terms of risk, which Proshare has also highlighted over time, plus its reports. And the Central Bank of Nigeria is recently beginning to push in that direction. So it's very important. The regulatory cost will be a major conversation, which is very important. The cash reserve ratio and other costs that needs to look at. We raise the AMCON cost too. Now let's look, Mr. Shitabe. I just want to ask you around the Proshare Bank Index, the PBSI indicators. They're most likely to differentiate the cohort over the next reporting cycle based on the report. I'd like your input too to these issues raised around how banks can be enabled to further intervene in productive sectors.
Thank you, Walter. But before I answer your question, I think Mr. Olufemi Awoyemi had raised his hands and he wanted to make a contribution. So, Mr. Awoyemi, could you kindly make your contribution?
Okay.
My apologies for getting it, but there are very serious issues being raised by Johnson, the panelists, that I think should not go like that. One is that the CBN has taken actions that reflect policy tension, in my own estimation. For example, how does the CBN reconcile the sterilization of banks' liquidity through the CRR with its objective of expanding credit to the productive economy?
The economy to a $1 trillion economy by 2030. Now, let's leave the date line. It could go beyond that. But even to reach there, we've got to be able to provide credit at rates that ensure organizations, micro enterprises, medium-sized enterprises, large enterprises can compete. That competitiveness is being hampered by the high cost of capital. Proshare has continually argued that it is important for the CRR to be reduced. 45% is high. Banks don't have those liquidity. And if the bank doesn't have the liquidity, you're talking about AMCON, like Dr. Abel said. You have AMCON, you have NDIC, you have liquidity ratios, then you have CRR. How much of the depositors' funds are available for actual lending? That's a very critical issue I believe needs to be resolved, and urgently too, if we want to increase the growth rate of the Nigerian economy to about 6 to 7% per annum, which can now perhaps aid our progression towards the $1 trillion economy. The real sector is actually under siege. And the only way to do it is to be able to look at some of these costs and bring them down. We are not oblivious to the fact that the CBN is conscious of the inflation rate, currently at 50.91%. We know that the CBN has committed itself to reducing inflation to single digits. But in doing that, we also need to allow the economy to grow. And we can't get that growth if interest rates are as high as they are currently. That being said, I'd also like to make a point that Mr. Johnson Chukwu made about concentration of credit risk. That is an important point. I think it was to see specialist institutions with specialist credits. In other words, we need to see institutions where there's a competence in a particular sector of the economy or a combined sector of the economy. So I know that, look, if I want to go into agriculture, this is the bank, or these are the banks I can approach for agriculture. They have the expertise. Piggybacking on what Mrs. Oladosu said, competence, building up the competence. In fact, that was one of the major failures of the first recapitalization exercise. That was the problem. Banks suddenly had a lot of money, but did they have the competence and capability to be able to discern how that money should be employed effectively? In that era, no. In other words, we did what we call the Peter principle. We grew those banks to the level of highest incompetence. So the banks had money, but they didn't have the competence to support that money. And I agree with Mrs. Oladosu that we've got to take that into account while considering this large amount of recapitalization. And my final point on that issue is basically this. Equity is not the primary source of loans and advances for banks. Mrs. Oladosu said correctly that banks are intermediaries. They're not investment companies. Investment companies raise equity and then put it into ventures. But a commercial bank actually should mobilize depositors' funds. The equity serves as a buffer. That buffer is a fallback position. It makes it more comfortable that once it lends, if there are any unforeseen circumstances, it can absorb whatever loss comes to it. So the equity shouldn't be seen as a primary source of lending. That's another thing that I just wanted to say there. Now, when you come back to the Proshare report, like you talked about, one of the major things that we talked about in the report, in the cycle in question, is that banks are going to have to rethink, re-engineer, and reimagine their business. That's just the reality. It cannot be business as usual. Those days are gone. We've got to have a deeper understanding of the Nigerian economy, not just its direction of travel, but its destination. What is the end game? Okay, we do $1 trillion economy, so what? While we're doing $1 trillion economy, another African country could be doing $3 trillion. So it's not just about the direction of travel, which is laudable in itself. It's also about the end game. Is there clarity over the end game? And for us at Proshare, that is critical. And in our report, we stated there clearly. And that's one of the reasons why we looked at the price to book value across the continent and saw that Nigerian banks were underpriced. And we said, look, this underpricing must be for a reason. We discussed with officials of Morgan Stanley, for instance, and Goldman Sachs. And they said, yes, well, Nigerian banks truly, they are underpriced. However, that underpricing reflects the quality of risk assets, which is an area we had not emphasized in our previous reports. But in this report, your risk assets are taken into account. It's a fundamental consideration as one of the 25 variables we used in this report. So your loan loss provisions were assessed. Your non-performing loan ratio was also assessed. And that was put in a general pool where we looked at your cost of funds and the cost to income ratios. So we had a variety of ratios where we clearly were interested in not just the size of the institution, but the quality of its deployment of capital effectively. And I think that's one of the reasons why we've seen a bank like Wema rising to a top position. in the current rankings.
Okay.
Thank you. Thank you very much, Mr. Teslim, for that insight. So we're going to, because this is a very dynamic webinar, and I mean, interesting conversations have come up. So we're going to just, in the third round of questions, we're going to just engage based on some critical issues that have been raised in the conversation. So, Mr. Chukwu, just like the chairman of Proshare has raised, how does the Central Bank of Nigeria reconcile the sterilization of banks' liquidity through the cash reserve ratio with its objective of expanding credit to the productive economy?
So sorry, before Justice Chukwu replies, because Teslim did not address the point. Let me expand on that key question.
Okay.
That question has been raised by so many senior analysts in different forums. But the central question behind it, which is for Dr. Ebo, Bumi, and Justice Chukwu, is the following. So why does the CBN continue to apply a uniform CRR across banks, despite differences in their capital levels, balance sheet structures, and risk profiles? And then when you look at that question on its own, in answering it, ask yourself, therefore, what I call the tension, the policy tension, or what I call the policy contradiction in saying I would impose this level of CRR, but at the same time, I would expect you to expand credit to a productive economy. I believe it's a central question. It has nothing to do with our banking. It just has to do with our understanding of how the financial architecture is linked directly into the business architecture of the enterprise. My apologies, Mr. Moderator. I will not interfere again, but I really honestly needed answers from these professionals on that singular issue for me to understand what is going on. Thank you very much.
Thank you very much, Chairman, because that was also something that with what you've raised was really on my mind, like how can we begin to have a consensus on this issue? So, Mr. Chukwu, let's begin with you, your response in 2 minutes.
Okay, let me start by thanking Mr. Oyemi for your intervention. I mean, that further shapes the conversation we're having this morning. Let me play the mind of the central bank. And that is, if I'm going to play the mind of the central bank, the first thing that will come to my mind, assuming I'm the central bank governor, is that what is my primary objective? What is my ransom the entry? What is the primary purpose of the central bank? It's price stability. So the support for economic growth is secondary. The economic growth is the primary responsibility of the fiscal authorities. So what we're looking at, how do I harmonize my primary objective to the larger interests of the society, which is to ensure that the economy is growing at a faster rate? And so that's where, so if there's a conflict between the role I have to play to justify my primary objective and the secondary role that I need to play to support another critical segment of my role, so I will prioritize, I will start from my primary role, which is what the central bank has done. Mr. Oyemi and myself have spoken extensively on the need for the central bank to prioritize economic growth against inflation moderation, or keeping inflation low, because some of the things I've argued in the past that if you have an improved rate of economic growth, the level of productivity, that the improvement in productivity will eventually bring down inflation on a long term. So, but that's not, so in a conflict, like I said, so that's playing the mind of a central bank. So look, my primary objective is keep price stability, keep prices low. So if the central bank is to bring down the cash reserve ratio, because you have to look at the structure of the Nigerian economy. Because we don't have consumer credit, the material of transmission of monetary policies, which is through consumer credit, is weak in the Nigerian environment. So the central bank has to adopt extraordinary tools to ensure there's a transmission between monetary policies and their economic activities. When you have a strong credit culture, what happens is when the central bank increases monetary policy rate, cost of borrowing becomes more expensive, consumers slow down consumption, and as they slow down consumption, demand for goods and services slows down, and productive activity slows down. So when they want to stimulate economic activities, they bring down interest rates, and then consumers begin to consume. But we don't have that. That connection does not exist in the country. So the central bank has adopted another extra, which we have dealt with separately. There used to be a stabilization security, which is almost what the high cash reserve ratio it has replaced. So what the central bank has done, they said, look, go and lend out, but you have a cash reserve ratio of 45%, which leaves you 55%. If you add the 30% liquidity ratio, then you are now talking of 75%. So what you actually effectively can lend out is just about 25% of your risk assets. And that's the reality we have. But having said that, the next question is why is the central bank still adopting a uniform cash reserve ratio for the banks? I will say that for deposit money banks, they have a uniform ratio. But for merchant banks, they have a 16% cash reserve ratio. And then there's also a tiering, a discrimination for those banks that have government, what they call government deposit that's not going through single, what do you call it? That is where they have the arrangement they have where the money goes through remitter. So for those banks deposits that are outside that range, the cash reserve ratio is 75%. So, I mean, it's 75%. For single treasury account, any deposit that's outside the single treasury account, the cash reserve ratio is 75%. So you have some level of discrimination. But if you look at the capital base of banks, and you look at their balance sheet size, and you look at their risk asset structure, then the question becomes, should not be further discrimination? Should the cash reserve ratio not be tied to the exact capital base of the banks, to their quality of risk assets, to their total risk asset exposure, and then so that those who are lending, who are really supporting this sector productive activities, will have lower cash reserve ratio. At the time that, if you recall, Mr. Wemi, there was a time the central bank adopted that and said, look, if you increase your lending to the risk sector of the economy, your cash reserve ratio will come down commensurately. But unfortunately, we're taking that out. So maybe one of the things we should be advocating is that the central bank, if really wants to balance the conflict between maintaining price stability as well as stimulating economic growth, he has to reintroduce that strategy, that policy where as you increase your lending to the critical sectors of the economy, then your cash reserve ratio will come down. And if you do not, then your cash reserve ratio will be withdrawn to compensate for that lack of lending to the risk sector of the economy. Probably that's one of the things we should go back, we should be presenting to the regulators in this conversation.
Thank you, Mr. Johnson-Chukwu. I mean, the last thing you just said is very critical. So central bank incentivizing banks and say, okay, if you increase your lending, we review your cash reserve ratio. I think that's a very major takeaway from what you've said, which of course analysts, experts, and participants would take from. Dr. Ebo, to you, what's your perspective on this issue raised in 2 minutes?
Yeah, so it's also in line with what Mr. Johnson has really highlighted, because it varies across it means the type of license you have. So you have the commercial banks, that's 45%. You have the merchant banks. And I think the other one Mr. Johnson was trying to say was the TSA for those, the TSA. So it varies. But I feel that what we should, CBN should also look out for is bringing down that rates. Because if we want to bring down the cost of credit, you can't sterilize a significant part of the deposit. I know that the CBN is trying to stabilize in terms of funds going into FX stability, which they have achieved to a large extent. Reserve is robust. So there may be need to have a rethink to see how they want to relax to increase the available funds to the bank, because it goes beyond just sterilizing these funds. If you want the banks to lend, at what cost should they lend? And that is what also matters to those that are taking the credit, because even higher cost of lending can also lead to higher non-performing loan. Because if the bank has to, the businesses have to borrow at 30%, it means that any business you are going into, your margin should not be lower than 50%, because cost of funding is not just the cost you have to cover. Cost of doing business in itself is high in Nigeria. So by the time you factor in the cost of doing business, taxes can also, when you look at what you even pay to the government, the regulators. So these are the ways I think we can, we should also be, so it has to be reviewed downward in light of the stability that has been achieved within the FX environment. I know that the CBN is also in looking at inflation, but we have all seen that bringing down inflation is beyond monetary policy. The fiscal authority will see food inflation. There's a limit to which, no matter the intervention, that CBN can control inflation. So the monetary aspect, if we're able to achieve lower cost of credit, that would also improve the overall economy. And beyond that, I think maybe to also add is that we need to also look at the so that's credit rating of the individual. So what is the credit? It needs to be harmonized. Yes, you can go and do the credit check, but we have to fast track that issue of attaching it to your NIN, attaching it to your, so that there's a credit score is the word I'm trying to look for. That when Wema Bank sees my credit score, the rate at which I would borrow will be different from someone that has been defaulting. That in itself, psychologically, we see in developed clients, people get credit for them to achieve, even if they don't need it, a lower credit score, which means that when banks see that you are at a particular threshold, it will help that they know that you are ready to take credit, and it should not be at the same rate as someone that has a higher credit score. Thank you.
Thank you very much, Dr. Ebo. Mr. Ladusi, you can hear the advocacy Mr. Chukwu has talked about, linking increased lending to reducing capital cash reserve ratio, and of course, Dr. Ebo is talking about addressing issues around cost of lending and looking at the high interest rate regime. So for you, Mr. Ladusi, you have the floor for 2 minutes to just speak around these issues raised. Your thoughts?
Okay, I think the speakers have done justice to this, but let me now take the position of maybe a non-financial person. So because they have given us professionally what should be done. So if I want to take the position of a non-financial person, on the part of CBN, CBN has a responsibility. And that responsibility is to keep the economy intact, both the monetary and the financial policies. And that is what CBN is doing. So any CBN will intervene when there are situations. And I believe that CBN came in with that policy on CRR, liquidity, to stabilize the economy in terms of liquidity, in terms of inflation, in terms of FX volatility. But it should not be a one and for all weapon. It should be a weapon that attend to emergency. And once you stabilize the water, you try to wave your sword in another direction. So I will expect that as the stability unfolds, CBN will be looking at another way of minimizing the impact on financial institutions. But, you know, to be candid, they are trying to do their work, what is expected of them. However, bank on the other side, I'm trying to do my job too. As a financial intermediator, I'm trying to do my job. So the issue is that now CBN is doing it. So why we wait for CBN to look at a better situation when they can adjust this rate on the part of the bank also? What is the responsibility? I want to give credit. But now we are looking at just two parts of the economy, the regulator, the financial institution. What about other parts of the economy? Because if CBN has left me with 25%, why can't I deploy the entire 25% wholly and timely? It's because there are other aspects also that are not doing their job. If a manufacturing company has light, as a layman now, I'm talking as a layman, there is light, there is market, there is road to the market through good transportation. The remaining 25% in my hand, I can conveniently give it to him. And then I can be driving the economy with that. But the issue is that the third party that I want to extend the credit to, some are not even ready. Those that are ready, the other part of the economy is not supporting them. So it's a fold that everybody has to work. The CBN is doing its job. The man that is in charge of agri, is he doing his job? The man that is in charge of electricity, is he doing his job? The one that has to do the road, is he doing it? Because if we focus on CBN and financial institutions, we might be leaving a large number of contributors out of the matter. Like I said, we'll wait for CBN because I believe they can see this and they can see that, look, something needs to be done so that we don't have policy somersault. You can't be taking it away from me in one hand and you are expecting me also to give out from the other hand. What am I going to give? But the truth of the matter now is that other parts of the economy need to rise up so that the little that is within the bank jurisdiction, we can deploy. And that is my part of the entire thing, because the speakers that have spoken ahead, yes, they have said it. But the issue is that I'm doing my job. CBN is doing its job. The unfortunate thing is that the two of us cannot come to a congruence because other areas of the economy are not working. So if I'm sure that when I deploy to a micro organization like an SME, I want to give you money as a fashion designer. Do you understand? The electricity is supporting your work. The road is supporting your work. The housing is supporting your work. So when I give you money, you can concentrate, do business. The little profit you make on it, come and pay back my money so that I can extend to the next person. And then while we continue to rotate that, CBN is seeing slight improvement in liquidity in the system, in foreign exchange volatility, in inflation, and then they are relaxing gradually what is in their hand. So the summary of it is that it goes beyond the CBN and the financial institution. Other area of the economy, which I will hold government responsible, need to work so that we can land safely. Thank you very much.
Thank you very much. This is Oladosu. You've clearly said it that the central bank has its own role from its monetary policy standpoint. The banks also are financial institutions that have to create value and, of course, make the right investments or lending. But the other hand, which you've raised, is more around the fiscal side, whereby the infrastructure, like power, infrastructure around linkage roads and others, enablers to sectors like manufacturing, agriculture, that are productive sectors, have to be addressed. And those are critical issues that we must continue to engage on. Thank you very much, Mr. Oladosu. We just want to acknowledge some personalities that are participating in our webinar today. We have Professor Broaden Adequacy. He's the founder and chief consultant of B. Adequacy Associates Limited. Thank you for being part of this webinar. We also have Mr. Sadiq Safriyu. He's of the European Bank of Reconstruction and Development. He's joined the webinar. We thank you all, and we appreciate every other person that has is part of this conversation. Thank you for sending your comments and questions. We'll take them as we get to the Q&A session. So we'd like to, going on this conversation, it's a very interesting one. I'd just like to now tie to Mr. Shitabe. So Mr. Shitabe, based on the conversations raised, we would just like to get your perspective on how we can really, from the reports, enhancing productive lending and the issues raised around fiscal and monetary. In just 2 minutes, what can be done to enhance and achieve a consensus in this regard?
Also, you know, in the old days, when you get answer to your question ahead of the examination, it's called expo. I think all the speakers earlier have given expo. They've already given answers that I would have wanted to prefer already. So I'll just say this. We're actually at a catch-22 situation. And why I said that we're at a catch-22 situation is this. I hear the banker talk about the other sectors of the economy needing to do well before she can advance loans. But these chaps are saying, look, I have a great business opportunity here. I can do this. But the cost of funds is too high for me to execute because my return on investment would be too low for me to attract maybe equity capital, for instance. So I'm at a rather difficult situation where I'm saying, okay, which comes first? Do we wait for the government to improve the roads? Do we wait for government to improve electricity? Do we wait, or do we work around government? Because from experience, it's going to be a very long period wait for roads to be in decent conditions, for electricity to provide us with at least 40 to 50,000 megawatt hours per day. I mean, we're currently doing less than 5,000 megawatt hours per day. How we're going to ramp up within a reasonable period is going to be really difficult. So what you're seeing in Lagos, for instance, is that new housing estates that are being built have opted to provide their own electricity. One of the things we've seen in, I think it's Abia State, we've seen a private electricity supplier provide electricity to Ariare market. So yes, it's slightly more expensive than the national grid, but it provides constant electricity. So what we need to do is to think around current fiscal constraints and see how the financial services can creatively, through creative financing, support the private sector to grow within that framework of government constraints. Every economy has constraints. Unfortunately, the primary constraint in the Nigerian economy is infrastructure. Without the support of the financial services sector bending in such a way that it provides the required capital, it's going to be very difficult to see private sector working along the lines that Mrs. Oladosu is saying. That's my take on that. But CRR, I think we need to bring the CRR down. I've listened to the other speakers, the various methods that we can use to calibrate which institution should be paying which CRR. Brilliant idea. I think it's a brilliant idea. But for me, the important thing basically is that CRR should be reduced. Now, one of the things I would like to say is this. The basic assumption from everything we discussed is a classic monetary theory that money supply primary impact is on price. So for the economists amongst us, we are looking at MV is equal to PQ. However, one of the analysts or panelists has averted to a situation where productivity increments can be the product of an increase in money supply, and the impact may not necessarily be on prices in the medium to long term. What I mean by that is this. If we can bring down money supply, the cost of money, we'll find out that productivity will increase. Now, those productivity increments will grow the economy. And because the economy is growing, the CBN itself will have to be less tight on money supply because the economy is growing. So there are no inflationary fears because of the growth of the economy. So for me, my perspective is that we've got to work around institutional inhibitors, especially for public infrastructure like power, water, etc. We've got to look for private sector solutions to that. And one of the ways I think we can aid that process is for there to be increased liquidity. It will be guided. I'm not saying it should be a reckless increase in liquidity, but definitely I think the CRR should go below 45%. I hope I've done 2 minutes. Okay.
Thank you very much, Mr. Shitabe, for that. So we're going to go to a last lap of questions, which we'll take very quickly so that we can take comments and questions.
Also, please, I'm sorry for interrupting you, but I think Mr. Aoyemi wants to make a comment.
All right, okay. Are you to you, Chairman?
Well, Otto, I think there are quite a few questions that's available. I understand Dr. Adequacy has a question, but permit me to raise this question to the panelists. It's not often we get everyone, including Dr. Adequacy, around. How should investors interpret current bank stock valuations and price movements in the context of actual and potential capital increases, changing dividend policies, and the evolving revenue mix, which tells you where real income is coming from the banks? That's the question I really want the panelists outside a Proshare person to answer. I'll be more than glad if you do that. And then if you do that, please, can you allow Dr. Adequacy to also join in? Thank you.
So I believe each panelist can take within 2 minutes to respond to this particular question, and then we can take Professor Adequacy's comments for just a minute. Thank you. So we'll begin with you, Mr. Chukwu. After Mr. Chukwu will be Mrs. Oladusu, Dr. Ebo, and of course, would invite Professor Adequacy to make his comments.
Okay, thank you. I think what my earlier comment was pointing towards that for you to determine that the bank's profitability has actually increased relative to its capital, you have to look at the earnings per share. Interestingly, only about 4 banks have published their half-year report. So one of the things you look at is that it's not just about the magnitude of increase in net profit after tax. You have to look at what is the earnings per share and what was it prior to the capital raise and what it is now, adjusted earnings per share. So it's only when you are seeing an improvement in adjusted earnings per share that you can actually say the company, the bank's profitability has improved relative to its increase in share capital. There is a risk because the banks have seen a major jump in their share capital base, where equity capital was previously 25 billion, and now we're not talking of 200 billion. So, of course, many of the banks did not have 25 billion when the capital raise occurred. The Central Bank legislated a new capital raise. Many of them had actually grown beyond 25 billion. But let's even assume you are even at 50 billion, and you now move to 200 billion. What you have seen is 300% increase in your share capital. So you have to look at earnings per share has increased by that. And I don't think any of them has recorded that level of earnings per share. Recorded that level of earnings in profitability. But the question is that what is adjusted earnings per share? And that is a critical measure of how profitable a bank is relative to what's due to the shareholders, relative to the returns due to the shareholders. And that's very critical. So, but it normally, because business investment are incremental in nature, so you may not have a commensurate earnings per share relative to what it was. But if the bank has a sustainable growth in its profitability, over time, it will deploy the additional capital. What has happened is that many of the capital, particularly for last year, you will realize that capital, the central bank approved most of the capital towards the end of last year, or some of them even early this year, because remember the capitalization ended by March 31st. So many of the banks had the capital come in towards the end of last year. So if the capital came in towards the end of last year and it's factored into their share capital, then it is very likely that that share capital, the additional increased capital, has not reflected in the deployment of earnings or a generation of earnings. So you will likely see a decline in EPS. But if the bank now fully deploy that, and that you have to look at is this: what is the cost of equity and what is the cost of capital? You know, the weighted average cost of capital will include the average cost of equity. And what is the effective yield return on earning assets of that bank? Because what happens is that when you have a material increase in your share capital, you realize that it dilutes the earnings, the return on earning capital, on return on the earnings from your deployment of capital until you get to that level of optimum deployment of capital. So measures that we have to look at is that what is the return on earning assets of the bank? What is the return on total assets? What's the return on equity vis-a-vis prior to the capitalization? It is very likely we should expect moderation in those parameters. But as the banks improve their investment, which is the major challenge we're going to be dealing with, and that challenge is that we have investable outlets that the banks can deploy this additional capital to generate the level of return that we are getting at a lower capital base. Until we see sectorial performances, which is what we're talking about productivity, where lending can take place beyond lending to government. And when I talk of lending to government, buying of government instruments. And my concern is that we may actually be seeing credit seeping into the capital market without direct lending to capital market operators. I am concerned that we may be seeing, because of the level of return coming from the capital market, we may be seeing equity credit going into that market indirectly, not as direct lending to the capital market. And if that becomes the case, then we're dealing with some other increased level of risk in the economy. I stop at that.
Thank you very much, Mr. Johnson Chukwu, for the key issues you've raised. I will now move on to Dr. Ebo in 2 minutes.
Okay, thanks. I think Mr. Johnson Chukwu has covered mostly, but what I will just also just touch on that investors would interpret more on based on the recapitalization, what should they be looking out for, is that it's going to be over time. You know, currently we will say there's a dilution because shares outstanding have increased. It is now based on the value they are able to create that would increase the profits of the banks at a higher rate relative to the dilution that we're seeing. And secondly, you know, based on the question Mr. Oyemi asked, for the bank dividend policy now, there are a lot of policies that is being introduced. The proportion of shareholders from now international, if you have international affiliations, how does they affect it? So I think that we have seen like a repricing of most of the banks in the last 2 years, based on which it has anticipated the capital raise. So what will distinct some of the banks for going forward would be dividend payment is critical to a lot of Nigerian investors because market sentiment also plays a major role beyond fundamentals. What investors think or what they think towards a particular stock. So I think by and large is that the profitability and the sustainable profits of most of the banks, their consistency would influence the pricing that we would see going forward in most of the banks.
All right. Thank you, Dr. Ebo. Mr. Laduson, in 2 minutes, if you want to add to this conversation.
Oh, thank you. I must say that the speakers have wrapped everything up. But what I want to point out is that when a bank has good capital adequacy, it just tells you that that bank is safe. But the capital productivity itself is what we tell if there is a future for that bank. And how do you measure the productivity of that capital? Is all the things that they have mentioned. Is there consistency in the growth of the NIM, in the return on the equity, in the return on the asset? And then the NPL, what is happening to it? Then another silent thing that you look at is that look at the diversification in the credit portfolio of that bank. Have you seen any efficiency? Maybe prior to raising capital, maybe they concentrated in one area. So now that they have raised capital, have they tried to look at other sector? Have they tried to, you understand, allow the capital to work in the benefit of the economy? You understand? So what I'm saying is that it is now the productivity of that capital that will tell you if the organization is investable. So you will look at all those ratios, and then you will be conscious of the diversification that you are seeing in the lending. And at the same time, what are the quality of the asset that is being created? Because you will look at the impairment. It's not only loan that is being impaired, even market purchases are being impaired, even fixed asset being impaired. So you look at the NPL of that bank, then you can say, oh, the capital adequacy ratio is good, the return on equity is good, I can see that NPL is stable, and I can see that there is diversification in the asset quality. That would just be what I will add. Thank you very much.
Thank you very much, Mr. Laduson. Now I'd like to invite Professor Biodun Adedipe to just make his comments briefly in 2 minutes.
Okay, thank you very much, Dr. Abasi. I think I'm coming in at a very good point based on what speakers have said in terms of how earnings per share, return on equity, return earning assets, return on total assets should behave, capital productivity, of course, the dilution and dampening.
Prof, sorry to cut in, Prof. Can you put on your video so we can see you?
Oh, okay. I have only audio permission here.
Okay, audio. Can go on.
Yeah.
Can go on.
All right. Thank you very much. So, very quick, addition here. What all of this mean is that the run rate of the banks has to be faster in order to get all these ratios to match what they had historically. And if they have to run faster, what does that also mean in terms of growing along their sustainable growth path? Which means it is possible to run faster than a sustainable growth path, and that is a crisis. All right. And if you run slower also, you are exposed to predators. That is corporate radar. We've seen all this play out in the Nigerian banking system in the last 35, 40 years that we are tracking the system. So what will then matter is the critical thing we all talk about in the stock market, which is to say that the price of a stock is defined by the future plan for that particular stock. So strategy will become very, very important at this point in time. So if I take the investor's mind, why will I invest in any of these banks that is massively, capitalized? And I take my mind back to sometime in 1998. This guy was, he happened to be a younger brother to friend, walked into my office and asked me a question because we were doing some work for a listed bank at that time. And he said, Ebon, why should I buy the shares of that bank? I said, why? He said, well, the return on equity of that listed bank was less than the return on treasury bills. Which means if I invest in a treasury bill which is risk-free. So I will do that and go to bed. If I'm taking a bet on this bank, it should be able to give me a return higher than that of a risk-free instrument. So for that stock with me now, since that time, almost 30 years now, question now for me is, what are the plans of these banks to grow their earnings in a way that the ratios that Mr. Chukwu talked about earlier on also are enhanced to match the historical performance of those bonds? So for me as an investor, that would be the critical question. What are they going to do? The strategic initiatives they will introduce. In spite of all the constraints we talked about, 25% only of your deposit book available for lending and all of these other constraints. So I will stop there. Thank you so very much for the opportunity.
Thank you so much, Professor Adequacy. You've raised a fundamental question, of course, aligning with Mr. Johnson Chukwu. What are the strategies of the banks to grow their ratio? Every investor will be looking at that. Thank you once again, Professor Bill Adequacy, founder of B. Adequacy Consult Limited, for finding time to be part of this webinar and making your contributions. We just want to acknowledge also some other personalities have joined our webinar. We want to acknowledge Dr. Funke Medun, CEO of Lipo Limited. Thank you for being part of this webinar. And of course, Mr. Marcel Okeke, economist, financial analyst, and CEO of Manscott Consult. Thank you for being part of this webinar. We'll quickly now take our final poll for this webinar, and then we'll now go to our Q&A quickly as we begin to wrap up the webinar. So invite you all to participate in our final poll for the webinar. Thank you. Thank you for participating in our final poll, and we appreciate you all for being part of this. Now we'll move now to our Q&A session. We have some questions already for some of the panelists, so I would plead that it take each answers wrapping it 1 minute so that we can really work within time. So the first question goes to Dr. Ebo. Can you share your view on the current level of the CRR? Do you consider it among factors that limit productive lending, even though the CBN says it's to help achieve price stability, controlling inflation? In 1 minute.
Okay, thanks. I think we have spoken extensively on that, and I think that it should be reviewed downwards in light of the stability that has been achieved in the FX market, and also it does not solve the inflation problem. CBN is trying its best, but that's not the silver bullet to the several array of problems that the fiscal authorities also needs to face. There's insecurity, there's infrastructure gap, policy consistency, a lot more. And with so as a result of that, the economy or the consumer should not be punished as a result of trying to ensure that inflation comes down, because at the end of the day, it still fits into inflation. Because when the cost of borrowing is high, cost of production would be high, and cost of selling things will also be high. So you would see that it's like a chicken and egg situation, and it's really important that we bring down at least to a reasonable level. And importantly, because it's my last focus, that regulatory cost, there's a need to review, given that the industry has grown bigger, maybe bringing down the percentage ratio, and so that it does not continue to tell, especially on the bigger banks, based on the increase in their total assets.
Thank you very much, Dr. Ebo. For Mr. Johnson Chukwu, what concrete metrics should shareholders watch in the next 12 to 18 months to judge whether banks are actually deploying the over 4.65 trillion raised productively rather than just sitting on it?
Okay, I need to also bring something before I answer your question directly. You know, it's fallacious to believe that the banks, because their capital has increased, will materially increase lending. The lending will come from increase in deposits. So we expect that the increase in capital will engender improve confidence in a depositor that they will increase the level of deposit. But it all depends on what level of deposit is available in the economy. What is the level of private sector deposit available in the economy? Because the government deposit is not really there, given that even the non-TSA deposits attract 75% cash reserve ratio. So having said that, it then means that the bank's ability to lend may be constrained by the ability to increase the level to which deposits are increased, because it is the deposit, the risk, the equity is supposed to be as a cushion, as a fallback position to enhance the ability to absorb defective risk assets. So metrics that people will be looking at for is that, I say, a material improvement in overall credit to the critical sectors of the economy in terms of proportion of size of credit and share of credit of those critical sectors of the economy. 2, what is the quality of the new credit that has been created? Because the cost of credit will come back to what the bank that creates weak credits. 3, what is the diversification in terms of earnings from non-firm-based activities? Your fees and commission, your transaction charges, which will actually show that the bank is going the right trajectory. And then 4, those ratios, earnings per share, dividend per share, return on equity, return on earning assets, return on total assets. Those are the parameters that we're going to be looking at for in the next 12 to 18 months to see whether the banks are growing in a sustainable basis, on a sustainable trajectory, and that the increase in share capital has created a larger, a bigger financial system so that deposits increases and the bank's ability to lend will increase overall.
Mr. Oladu, I have an interesting question for you. Mr. Oladu, so it says that you've talked about the concerns limiting productive lending to the banks, but as Nigeria is heading to a political season, as campaigns begin this month, would you consider this a risk period for productive lending for the industry?
Thank you. Election around the corner, we know the culture. But that goes to ask a simple question. What is your credit creation pattern? What is the strategy that guides your credit creation? So if you have a strategy in place as a bank that guides your credit creation, the quality of asset creation, election or no election shouldn't be a determining factor, because the kind of sector you'll be lending to, the kind of corporate outfit that you'll be lending to, the size of your lending, the period of your lending, the nature of your lending will guide you to know either to push out credit at this critical time or not. You might say there's going to be a problem if you don't have a strategy in place. So somebody comes forward to take money and the money is used for election. That means you don't have a credit guide in place. That means you've not done your assignment. That means your monitoring is having problem. So I want to say, from the perspective of a bank that has a working strategy when it comes to asset creation, election shouldn't be an issue at all, because you should know where to deploy your capital to and where not to deploy it. But of all that we have said, what I would say is that banks have raised capital. Some things are required. There must be increased monitoring. I'm not talking of regulatory now. We're talking about the organization itself, the institution. You need to increase your monitoring. Then you need to do a lot of structural, I won't call it adjustment, or structural reorganization to absorb the kind of capital you are carrying now, which has to do with the people. It has to do with the place. and it has to do with the pricing. And then you need to have good execution plan in place. And to capital, your corporate governance need to increase. By the time we put all this in place, I don't think the timing has anything to do with the success of capital deployment or credit creation. Thank you very much.
Thank you very much, Zolado. So we have some questions that have come up, but we want to assure our participants that would, to people that are sent to, there will be response to those questions appropriately, and we would give you feedback on the questions as we are working within our time allotted for this webinar. So I would now, at this juncture, allow our esteemed speakers to give their closing thoughts in 60 seconds each, beginning with Mr. Chukwu, going to Dr. Ebo, Mr. Ladosu, and Mr. Shitabe.
Okay, thank you, our viewers. Thank you for the audience. Thank you, the audience. Thank you for the moderator. Thank you to the moderator and our chairman, Femi. What I would say is that the banking industry is a lot more viable, stronger with the capital raise. And the challenge, ability of the current management and leadership of the banks to effectively deploy the capital. To do that, they have to look at growth sectors of the economy. They have to look at the quality, the ability to manage the expanded credit, the quality of skills they have to manage the expanded credit. So they need to strengthen their governance framework and governance standards. And then they also need to recognize the fact that the economy has shifted materially, and income from the financial services industry is going to come largely from non-based activities in the near future, so that they don't, they know that the cheese has moved, and they don't get stuck with they are only going to lend and create revenue from lending. Those are my thoughts.
Thank you very much, Mr. Chukwu. Dr. Ebo.
Okay, thanks. So I would say that the capital has been raised. It's like a permanent capital compared to when they use debt. So it means that no obligation to pay interest, like if it's were to be debt. But we also know that shareholders also have expectation. So banks with this new capital raise, the focus is on creating value, so that confidently, when you look at the splits, close to about 73% of the capital raised within the country. So that should also help to sustain that confidence. Also, I would wrap up with that banks should adopt more of scenario planning. We can see a lot of policies continue to spring up from the CBN angle. It means that they must be able to adapt quickly to those changes. And some of those policies, you also see that it's with immediate effect. So there's a need that they have to be more flexible in their planning and look at different scenarios. What if this happens? What do they do? So that they have those planned out. And I think by and large, I feel that it's going to be interesting times for the banks. Banks have come to know that it's not by number of fiscal branches. Technology is also going to be what would differentiate most of the banks because it will bring in efficiency. The use of AI, how can they also use that to improve customer adoption and intelligence on their platforms? So I think I would like to rest it there. Overall, thanks for this wonderful opportunity. And a lot of the discussions have really been very germane, and we're hoping that we'll begin to also see those changes and implementation in the near term.
Thank you, Dr. Ebo. Mr. Ladosu.
Well, thank you very much. I think my own appeal is generally to colleagues in financial institutions. I think now that we have raised capital, we shouldn't pursue growth at the expense of sustainable profitability. Yes, like a mid-sized bank, Wema, my philosophy is not because I've raised capital, I need to be back to back or side by side with those that have larger book size. So it's going to be according to my risk appetite. So let credit creation be according to risk appetite, and let that determine how you grow. Let the funding capacity that you have also be efficiently deployed. And then technology, let it determine how you scale. AI is everywhere now. We need to be very careful. That is the truth. Cybercrime is everywhere. So as technology is determining your scalability, there must be consciousness that has to do with fraud as well, so that overnight the entire capital will not disappear. And then the issue now is that everything has to be in line with your cost of capital while you try to protect the institution. And then with all this, we can all build a sustainable, growing financial institution. Thank you very much. I'm really grateful. I take this not for granted. And to every other person on the panel, it's an honor to have been on panel with you. I believe that we will have so much time to discuss after this. Thank you very much, Proshare. I really appreciate it. God bless.
So thank you to our speakers. I'd just like you to hold on a bit. We'll just do a group photo quickly, but I would like Mr. Chidebe, just 60 seconds, closing thoughts.
All right, thank you very much, also. Thank you very much, co-panelists. And thank you very much to all the participants on this webinar today. One of the things I'd just like to say is that I think everybody on this panel have provided very interesting thoughts on the way to move forward in the Nigerian financial sector, especially the banking industry. I will want to appeal to the banks to take more creative approaches towards extending facilities to the real sector of the economy. We need to grow the real sector of the economy. And I'm appealing also for the banks to look at opportunities in areas that are fee-based opportunities where they are actually arranging finances of lower cost to the real sector of the economy, as well as off-balance sheet transactions. I want to thank everybody again. I thank Proshare, thank all my colleagues also. I thank everybody behind the scenes working technically, participants. Thank you very much, ladies and gentlemen.
Thank you very much. As we look at wrapping this conversation, and then we'll have Mr. Marcel Okeke, the CEO of Mascot, just wants to make a 60-second contribution. So we'll work within that as we're wrapping.
Okay, thank you very much. Thank you very much for this opportunity. As a matter of fact, I no longer thought I would be allowed to speak. But now I'm speaking. It's like everything has been said. By way of background, I want to say that the Nigerian banks are an integral part of the economy. And so the mere fact that they have just raised capital, will not make them to be magicians in this economy. I'm looking at the kind of challenges and constraints, that are before them. Okay.
Sorry, can you put on your video? Is it possible?
The system doesn't allow me.
Okay, you just go on,
yeah. So they don't operate in their own world. They are an integral part of the economy, and like a lot of people have mentioned, their credit facilities being extended to the real sector. When you look at the people in the real sector and what is happening to them, you find out that they are challenged. Somebody has mentioned the insecurity in the land. All of us know what is happening in that regard, and especially people in the agri sector. I have examples of people, whose farms have been burned several times over, and those people packed up. You come to the manufacturing sector. You know what they have been saying about the Central Bank of Nigeria's, tight monetary policy, the high interest rates, and the implication for local operators here, and so on and so forth. These people have a lot of challenges, such that if they see, the banks, because they have raised capital, are able to give out a lot of credit, they will be exposing to themselves, to the possibility of increasing non-performing loans and bad loans, as somebody has also observed. So by and large, it's something that somebody has also mentioned that we need to ask the government to do something in this regard, improving infrastructure, improving security in the land, improving because of doing business generally, or the environment for business, so that Nigeria no longer becomes a high-cost nation when it comes to business. It becomes more business-friendly, so that the prices of things that are imported into this country no longer goes better or go better than people who manufacture here because of high cost of operation. That's a serious disadvantage. And because of that, the operators in the real sector of the economy are so disadvantaged that even the banks that have the money don't see them as good customers when it comes to credit. So somebody also raised the fear that the banks could be routing their money through some instruments that are not so clear to us, but which will be yielding them the desired result, So I have written an article somewhere that is not likely that this bank, or why banks may not develop the economy as expected. There are a lot of challenges and constraints within the economy, beside what the bank themselves can handle, and beside what monetary policy can also handle, and so on and so forth.
Yeah. Thank you very much. Thank you so much. It's been a very interesting webinar, having contributions from experts and leaders. It's really been a very interesting conversation. Thank you once again, Mr. Masokeke, for your contribution. So as we wrap up, we would like all our panelists to put on their video. We want to take a group virtual photo just to cap this very interesting webinar. Thank you.
Thank you very much.
Thank you. Okay.
Thank you all.
Have a wonderful day. Thank you. Thank you very much. Yes, I would like to thank our speakers for taking out time of their busy schedule to engage in this virtual discourse on from capital adequacy to business resilience, assessing the outcomes of the banking recapitalization, mirroring the 5th Proshare Tier 1 Banks report, and charting a pathway for the banking industry post-recapitalization. We appreciate you all. Mr. Johnson Chukwu, Group Managing Director, Carrier Asset Management Limited, Dr. Ayodejebo, MD CEO, MDU Capital, Mrs. Bumi Oladosu, Chief CFA and Chief Financial Officer, Wema Bank PLC, and Mr. Testin Fitabe, Director of Research, Proshare. Indeed, the next phase is a test of capital effectiveness. This will imply market confidence must be earned through evidence, execution, and disclosure, clean, loss-absorbing capital, resilient real earnings, discipline, risk and impairment recognition, credible governance and disclosure, impairment realism, productive credit, and sustainable shareholder value. And I dare say a linkage between fiscal and monetary policy to enhance the banking industry. Thank you to all our participants for your patience, participation, and engagement. I commend, of course, the entire Proshare team for ensuring a seamless webinar, and also would like you to be a part of our analyst community, as you can see displayed. For further insights, log on to our website, www.proshare.co, and of course, follow our social media platforms. We also would like you to continue to engage on our platform and enhance the conversation. So as we close, we'll just allow our chairman who wants to make a brief input on this.
Nothing. I just want to say thank you all, and I wish you all the best. Have a wonderful day.
Okay. Thank you. Thank you very much. Thank you. So thank you once again. I'm Oto Basebase, Continued News Proshare. And like I said earlier, you can log on to our website and get further insights, a lot of reports, a lot of insights, market intelligence, economic insights. And we thank you all for being part of this webinar.